Hi, my name is Casey Hackett, and I will be talking to you guys today about gamma capture, specifically for intraday volatility for 0DT options. In particular, we are specializing in the S&P 500 0DT options as they are blowing up the number of trades in the 0DT area and just options area in general. As some other stretch goals, we want to be known as the 0DTE intraday volatility people, but we also have other products including gamma capture bands, which we hope replace Bollinger bands, and that's kind of what we want to be known for. Going over the team a little bit more, Lou Pelosi founded this group about a year and a half ago, taking an old paper and kind of converting it into usage for 0DT options. He is a derivatives broker with expertise in data analytics, and he's been incredibly helpful, not only for guidance, but actually a lot of the work on this project with us as well. Uh, Earlier this summer, I was brought on to help with some of the more technical aspects for coding. And then Caleb Johnson was brought on at the beginning of the year to help with that work and to explore some new avenues we were working on. We are official partners with the NinjaTrader ecosystem. That's where a lot of our indicators are housed right now and currently published for sale. So maybe it's just some intuition for why we should care about 0DTE options. Uh, Quite simply, they are rising in popularity very rapidly. S&P options were always a huge part of not only the options world, but just the general amount of market trading going on. And over time, the S&P 0DTE options world has just completely blown up, where in May 2025 it had its highest peak so far, and it only seems to be growing for both institutional and retail traders. This is kind of a more in-depth version of why we should care about 0DT options, but I think the gist of it is that as kind of our computing and data flows become faster and faster, the time horizons that people want to be trading on tend to get smaller and smaller to kind of press that advantage that they have. And, this kind of improvement in computation and data leading to smaller time horizons, the higher trading on small time horizons also, kind of this negative feedback cycle pushes back on computation and data flows to get even faster, which of course means that people want to be trading faster and faster. And we've gone from, a lot of people trading 1 month options horizons to now 0DTE kind of at its fastest it can be before we get into like high frequency trading. But with the current market structure, it means that both retail and institutional investors can trade 0DTE pretty easily, but maybe not well. So our product concept is kind of help people, both retail and institutional, break into the 0DTE world feeling more confident about the numbers that they're getting and the trades they're making. We do this by publishing a ticking intraday volatility based off of the past hour. We also compare it to the current IVOL from the current options chain and using gamma capture volatility, comparing IVOL and RVOL. We also calculate the straddle price for people to compare with the current market. We create Bollinger Bands, and we generally just want to be kind of a baseline for people to compare the current market IVOL and maybe other RVOLs that they're getting to feel more confident in their value. So rolling back to maybe kind of why the current system is broken and not working well for people. The kind of naive and gut instinct you might have when we move from 30-day options to 1-day options is to just take the VIX, the current king of the volatility market, or to standard deviation, close, you learned it in class, and move it from 30 days back to 1 day. This kind of has two issues. For the VIX scaling problem, you're losing a lot of the information that you have from the VIX. The VIX is used for larger time horizons and is built for that time structure and is not built for 8-hour time horizons. So scaling it kind of removes a lot of the information you're supposed to be getting from the VIX and tends to not be super representative of the market. Standard deviation is a great measure, but what am I supposed to do at 9 a.m. when the market opens? I don't use the, market closed hours information as my close standard deviation. The market open tends to be very different than the night before it. So maybe I wait an hour and I do close of the first hour. But what am I supposed to do? This is not that much data for standard deviation to be taking in. And standard deviation, given this amount of information, tends to really overrepresent high volatility periods and underrepresent low volatility periods, and just tends to not be a great trading signal based off of such low amounts of information. So this is kind of where gamma capture comes in. Gamma capture is closely related to gamma scalping, where people want to trade just pure volatility based off of, a certain upward and downward crossing, and, you buy and sell to hedge your position to only be trading volatility. They would observe a certain amount of volatility based off of the trades that they're making. And that's what gamma capture does. We have a barrier above and below the current price, And whenever it crosses, we reset the barriers and we make one count. And we just look at how many of these counts we get in a certain look back period. We tend to use 60 minutes. And based off of the number of, of crossings you get, that would be the volatility that a gamma scalper would actually observe during that time. And this tends to work pretty well amongst small time scales because you are getting a large number, a significant number of crossings in an hour, and it tends to be pretty representative of the actual market volatility during the past hour. So maybe we can roll back to the inception of the product and kind of like the first prototypes into the indicator space. This was kind of a proof of concept, just getting gamma capture into NinjaTrader, which is what you're looking at right now. And you can see we've computed the realized volatility using bid-ask tick data with a 60-minute look-back period. And this is useful and kind of nice to know, but maybe not the best indicator, but it's a great foot in the door. Next, we have looking at different term structures, different numbers of crossings we're kind of embedding into the barrier width, and for different look-back periods between 60 minutes to 240 minutes. These are parameters you can tune with gamma capture that we need to make a smart decision about when we develop this for other people. And this is just a good kind of exploratory lesson in where gamma capture works best. Again, hard to trade on, but good information for us as the creators of this product. And here we have it evaluating current options prices against the current market just to see, how it's doing. Again, hard to trade on. So that brings us to kind of like our simplification for traders. You can see this looks very simple, but that means it's very useful. Where we have the current gamma capture volatility in orange, 0.113, compared to the 20-day historic RVol of the option. This allows you to kind of gauge where current volatility is against, where you'd expect it to be for the product. And that allows you to know if you want to buy or sell volatility based on where we are right now. Very simple to look at. Next, we have gamma capture bands. These are in the orange, and we have them compared to Bollinger Bands in the blue, which you can see are very erratic and maybe hard to get a good signal off of. The gamma capture bands are less volatile, again, because we are more representative of actual market volatility, not just random spikes in the past hour. And again, can be used as breakout points to know if you want to buy or sell, especially you can see around the 4 p.m. market. That's a great breakout. And then finally, we have the at the money straddle break even points. This would just let someone know if they wanted to trade straddles or just options in general at any given time. How much would the stock need to move by the end of the day in order to make money? As you can see, we have 10, 11, and noon. And you can see that around the 2:30 mark, actually all of these would make money because they had exceeded one of the barriers of the at the money straddle break even points. So gamma capture is very advantageous in a lot of areas, specifically for small look-back horizons. It is very useful compared to standard deviation or scaling the VIX. It simplifies a lot of complexities of trading volatility into easy-to-use indicators. That being said, time is also, of the essence when trading 0DTE options. This is a great time-saving tool for a lot of, especially retail traders, and kind of embeds our knowledge of the market into three easy-to-use indicators that someone who's maybe learning the area or just wants to be able to trade quick can just look at, get all of that knowledge by proxy of using our indicators. So we're very happy with the three indicators we have right now that are currently published and people can purchase. We're doing a lot of work to work with data vendors to be able to use their data to publish this resource to larger groups of people. Caleb is working on getting this in TradingView and other platforms, and we're currently just expanding. We're super happy with gamma capturing. That's the core is that we can predict volatility, intraday volatility better than other people, and we're just exploring the best ways to get that product to people in the most usable way and most helpful way. Thank you.